Hey, it's a commodity report, and Kevin is back this week. No revolts this week, thank God. Um, so me trying to go through the fundamentals, even though I know them, I don't have the rhythm that Kevin does. So glad Kevin's back. We can kind of jump through a bunch of stuff because a bunch of things are happening, especially in the commodity space. Quite interesting things going on here today, especially crude oil was down big and then rebounded a little bit. Same with silver, same with gold. Copper is getting smashed, so kind of going across the board, we're seeing a lot of give back in some of the commodities. What's kind of interesting is seeing the move in soybeans up to 2%, over 2% today. Soybean meal up almost 2.5%. Soybean oil up over 1% today. Corn up over 1.5%. Wheat up over 1% today. So I mean the grains are looking really good, which is interesting because that has been the opposite of the positioning in the commodity market lately. Commodity market has been a precious metals driven bull market. Sometimes we see crude oil moving. Sometimes we've seen copper moving. Now copper is falling. Now crude oil is falling. And then the grains are up. Very weird position today to be in the commodities market, but that's what happens sometimes. Commodities are all different. That's why I love the commodities market. That's why there's so much alpha in the commodities market, because you can trade so many different things, so many different trends. 1 month performance, oats are leading the way, which is an interesting one. The Russell 2000 right behind that, up 8%. Now, a lot of people have known that the Russell is leading the way lately in the last week or so. And everybody's been talking about the Russell and small caps, and maybe we can get Kevin's view on that today a little bit, now that you guys have all heard mine and all the other guys. And the lumber right behind that, up 7%. Quite interesting. Hit a major support zone, bounced right off of that. Very interesting move in lumber. Soybean oil right behind that, up 7% in the last month. And coffee right behind that, up over 6.5%. So, Kevin, what are you seeing in the commodities market this week? We're talking a little bit off mic about this give back we've seen in some of these areas. So what are you thinking this week?
Yeah, so we are seeing a pullback in a lot of different areas here, Jason, and rightfully so, right? When you have the macroeconomic data that's coming out, not only here in the United States, but across the globe, it's not as robust as we have hoped for. And we know that has been a cornerstone for a lot of these commodity moves to the upside, along with some short squeezes. So let's start off with crude. So crude, actually, from a technical standpoint, and when I have my charts up, I'll try to get them to you. But we had a situation here, I'll just describe it, where we had a nice little power move to the upside here to start the year. We had a flag pattern back to the downside, and then we tried to retest, and we hit some really key areas, right? Breached above that $80 level, tried to go a little bit higher, but right now we're kind of failing again. We're giving a little bit more back to the downside here, and from a technical standpoint, it appears that crude wants to try to get maybe touch that 74 level before trying to power higher here. But when you have the EIA data that we've had over the last couple of weeks, we talked about this. What was going to be the key thing? You wanted to see the drawdown in inventories, right? For crude oil inventories. And you also wanted to see the drawdown for byproducts. About 3 weeks ago, we started getting that drawdown when it came to overall crude oil inventories. And we saw some nice drawdowns when it came to gasoline inventories and distillates. But the last two reports, the drawdown in crude oil inventories still remain fairly robust, right? The refining rates are still starting to decline, as we talked about. The third week and fourth week of July is usually where we see peak, and then we start to come down. But the buildup in gasoline inventories as well as distillates is still a concern. That means that the consumption is just not hitting as well as what we would have hoped. We talked about gasoline inventories too, 2 weeks ago. Man, I'm losing track of time. 2 weeks ago, we talked about gasoline or jet fuel inventories, and we expected this huge ramp up in travel. And we saw that ramp up in travel, but it just was not as aggressive or as sustainable. Now, we still have some more data to go, another couple of weeks here. Let's see if that's going to reverse itself. But it just appears that we've kind of hit a near-term peak when it comes to consumption across the board for the most part. And then when you're looking overseas, when you're looking at China data, when you're looking at CPI coming out of China, when you're looking at the manufacturing PMI data that's coming out of China, it's just weaker than what we have expected. And so a pullback, nonetheless. it might be healthy. It had a nice little run from what, $71, $72 going up to around 82 and some change, where you kind of rejected that. Sam's probably got the anchor VWAP on there to kind of reflect that. We pull back a little bit. You want to see a bounce at $74 and push higher here. But EIA data, I think, has been bullish until we started seeing the buildup in the byproducts again. And if we're going to have a buildup in byproducts again, that really doesn't foreshadow a strong fundamental picture for us to try to break out of 80, break out and try to hit 85 and sustain 80 to 85. I still think that range is still there, right? 78 to 85 seems to be the right range from a fundamental catalyst standpoint. It's just sustaining that level has been a little bit more difficult.
No, I've been looking at crude oil a lot lately, and that major triangle pattern that we continue to see building. This chart, you can see it right on the chart. You see this major triangle pattern. Volatility continues to squeeze. A big move is probably coming, but we really got to get sustainable over these major levels. We just haven't seen that yet. We continue to hit this, 80 to $85 level, and we continue to bounce under that very quickly. That's not something we want to see. We want to see us get over those levels, really sustain over those levels to really see we're going to see a major run in crude oil. Here, like Kevin has said before, we just don't have the right picture for all of this yet. But that might be coming. And really, I would continue to look to the charts to see when that happens. A big close over 85, seeing some stability over that number, and then continuing higher, taking out 90, even 95. Like, I'd be very bullish on these things, but we're just not seeing that just yet. And when things are consolidating, we don't want to get really crazy bullish or crazy bearish on things. It's just consolidating. It's moving sideways. See where it ends up. Crude oil definitely looks interesting, though. And so let's go to the next chart on here.
And can I just want to highlight something too, right?
Go ahead.
There was this narrative, wasn't last week, it was the week before last, right? The Fed's going to cut, and everybody's trading on that Fed cut, right? Small caps moving up. And I think we just need to just use caution when it comes to the Fed cut and when you're trying to trade commodities. Just because the Fed cuts does not mean that we're going to automatically start seeing fundamental data just rapidly move to the upside. In fact, that's usually the sign that we start seeing fundamental data across the board, from employment to consumption to credit, travel. That's where we tend to see, a peak maybe happening a month or two before, or we're starting to see a decline there. So if you're utilizing a narrative for rate cuts and you're looking at commodities, you can't trade them like this short squeeze that we saw at small caps. Don't equate the two, because a commodity can have a nice little short covering rally. You can also have speculators kind of getting into that FOMO. But if you have that FOMO and without producers also backing you on that, then it makes it very hard for that structural power move, right? We go back to, let's talk about, copper. I'm going all around here, but copper was the same way, right? At some point, once we hit to about $4.25, $4.30 with copper, that rest of that move to the upside was all speculators. The producers were like, hey, we know there's a problem here, but like, you guys are getting a little bit ahead of yourself. Commodities will do that. So just because we have that Fed cut coming and maybe happening in September doesn't mean that we're in the all clear here when it comes to the macro data that's really pertinent for energy. If you're even looking at metals outside of maybe gold, right? And maybe even silver in a sense, like you can make that case for gold, maybe for silver, but when you're looking at it for copper, that really doesn't foreshadow a really strong, robust economic situation here. Rate cuts take a long time for them to actually have an impact when it comes to economic activity. In a sense, I mean, you could still make the case that we're actually too low. The rates are too low compared to what the Fed should have done in the reaction time that they had expected it, right? They wanted to see this residual effect 8 months down the road after their first rate hike to start saying, okay, we're getting the job done. That never occurred. That means that the rates are still too low on a relative basis. Now they're starting to see that slow grinding happening in the economy, and they're saying, okay, we can start cutting rates. But when you cut rates, it's going to be the same thing, right? You should expect 8 months, 12 months, even 16-month lag time until you actually start seeing it fundamentally hitting the consumer, fundamentally hitting the economy. And so that's kind of like where I'm at with that. I mean, this is completely a supply story right now. And then the supply, I mean, we're seeing the inventory builds. That is a concern here, but there's a lot more headwinds when you're coming to with geopolitical events. Obviously, like every single day we have something that's like black swanish in a sense. And so if that's going to continue and maintain itself, then that could give you a catalyst move to the upside. But I would just stress caution. If you're seeing people on TV, as I've already seen it, you're seeing people on TV like Fed rate cuts, commodity, this is the time for commodities. It's like, you talk about technical signals all the time, right? I'm talking about a fundamental. You wait until that fundamental signal that says, boom, we're ready to go. Once you start printing a little bit hot, especially if you're looking at CPI, like if you're a commodity trader, I'm going on 10. If you're a commodity trader, what you want to see is inflation going up. You want to see inflation going up at a rapid pace in China. You want to see that inflation going up in Japan. You want to see the inflation actually kind of reaccelerating in the EU. That goes contrary to everybody's thoughts when it comes to Fed policy. But inflation and demand is what drives commodities. It's not the future policy, the policy in the future, what Fed rate cuts are going to do. If you're a reflationist, if you're those that believe that the commodities sector can have a super cycle or just a regular old power cycle to the upside, you want to see us run hot. You don't want to see us run cold. That's kind of the capstone of that commentary.
No, I love that because it's I think too many people in trading put everything into a box, right? And that's the problem that we continue to run into again and again and again. It's got to be this way. If we have rate cuts, therefore this has to happen. If we have rate hikes, this has to happen. It's the same thing in 2021. We had rate hikes incoming, so therefore the market couldn't continue up. It continues up for a full year. All of this stuff is ridiculous, and it's kind of like you got to figure out what exactly type of trader you are. Understand the supply and demand dynamics. Does that happen because of rate cuts and liquidity? Sure. But if you understand that, you can understand where the price should be going. Same thing if you're a technical trader, you wait for your signals. I've had so many people, because we keep talking about the grain story, and however, the grain story doesn't mean, yeah, we could have a great fundamental setup and we could have great things that are possibly going to happen, but it also has to confirm in the price, because we only get paid by the price going up. So I really think all of that is true. So Sam, on this chart, what are you seeing? What's levels people should be watching out for, target levels that you're looking at?
Yeah, to me, it's just a big base. That's what I see, is a smiley face, and it's just going to be messy. And we keep on finding resistance around the anchored view up from the early 2022 peak. So I think that's a good level to fade. I think more mean reversion strategies are appropriate here in crude oil. Until we see a sustained move above like the 84, 85 level, like you guys were citing, I think it's just going to be messy for longer. But I don't think that's all bad. The bigger the base, the higher in space is how I learned it. So
that's a good point. I always
Yeah.
like that quote: the bigger the base, the higher the space. The bigger the top, the bigger the drop. Like those things are really important, especially when you're building, because I think commodities mainly, they really build a lot of momentum in those bases. And then when you see those bases finally break out, you see those big moves finally happen. Think of cocoa for its 5-year base or whatever that thing was. It was a long time, a lot of choppy trades, but it had a very long-term base, and then it moved obviously to space and still hasn't really come down from those levels. So into the next chart we got here, we got the LME index. So Sam, what are you pointing to in this chart?
Yeah, we're talking about copper. This is kind of the entire industrial metal complex. and we've got a massive base, as I've highlighted, and we are finding resistance at a key level once again. And I've thrown the volume at price indicator there on the right, and I think it comes in just below 3,800 on this LME index. But I think on the longest volume at price bar, we could find some support and potentially put the finishing touches on this basing pattern. It could take some time, but that's where my head's at. I think these could be some of the best commodity trades over the next several years. So I don't think this is a bad place to accumulate some stocks. And I included SCCO next, but you guys can talk about this if you have anything to say.
Yeah, so Kevin, do you cover lead, zinc, nickel? Well, I used to trade all of these a lot, actually, and then the LME kind of screwed all of us for a while. So, Kevin, you got any thoughts on any of the other metals? I know you talked about copper a little bit, but anything else on there as well?
Got to unmute myself. All right. So if you're kind of looking at that index, oh, you perfect. You have it. So if you're kind of looking at it, I would say that I do follow some. So like 10, for instance, like had a massive rip to the upside. If you're looking at over in the China markets, they had this massive move along with the copper move as well, right? Everybody was kind of just trying to get into this space. You know, if you're kind of looking at it holistically and you're looking at this kind of formation that he has up here, I mean, you got two cups in handles. One kind of was completed and hasn't failed yet, right? The massive, the bigger one that you have, and then you have like a minor mini formation here that's still trying to make relative highs and making higher lows for right now. When you're kind of looking at it though, like if you're looking at aluminum, and I believe for that LME index, if I'm not mistaken, aluminum is a pretty big component of it, if I'm not mistaken, but I'll have to kind of go back. But aluminum is already like fallen off the map to the downside, right? Copper hasn't completely fallen off yet, but it's getting there. We talked about that range about a month ago, 425, 440, I believe. If I'm not mistaken, we had a nice little box chart, box range that was there. It broke down lower than that 425 level right now. So it seems like that one wants to kind of retrace, maybe trying to bounce off $4 and then try to regroup itself and move higher here. I haven't looked at lead. I haven't looked at a zinc chart, but I would assume that those products, for the most part, probably are in the same type of trajectory or trend as far as a pullback. Maybe I haven't looked. Maybe Sam knows, but I don't know, man. If you're looking at a long time frame, like he has it right now, can you make a case that it can go higher? Yeah, right. Like if you're looking at it from a longer time frame, if you're talking tactically for the next 3 months or so. I find it maybe a little bit difficult until once again we kind of have those fundamental catalysts that kind of drive us higher here. And we, once again, I go back to the industrial manufacturing side. Like we want those things to start ripping higher. We want the sentiment data to go higher. You want the new order data to go higher. That's actually a very key portion that has been very weak and in contractionary territory for the last couple of prints here. If you're looking at ISM manufacturing as well as Fed regional data here, so. Longer term, I think Sam's onto something here. Longer term, right? But if we're talking about tactically 3 months from now, I think it still kind of gets choppy until we get that first cut. And the reason for that cut, I think that's going to drive us the rest of the way. Now, if we get a cut and then they say we're cutting and then we're going to hold for a while because we don't want to also reignite inflation, that could also be your bullish sign for some of these metals as well. We're just not there yet. But I like the chart setup when you're looking at it on a 30 and 20 year time frame, almost 30-year time frame. This actually does look fairly constructive. What do you think, Sam?
Yeah, I don't disagree. Yeah, I think it'll be messy here for a while. I was just making the point that if you have longer time horizons, this is not a bad place to accumulate here. On this little dip.
Yeah, and
I think this support holds.
And you have some secular things that are going to be, when we talk about secular trends, we don't talk about secular trends as in 3 months, 6 months, right? We talk about a 15-year, 20-year time frame. Everybody's like, dogging EVs and hybrids right now, right? Like, oh, look what happened. But at the end of the day, that will be the future. We know that that's going to be the case. As technology gets better and better, the adoption of those particular systems are also going to increase as well, right? You have the artificial intelligence side of the equation, where metals like a nickel, metals like a copper, metals like you name it, will be in large demand, not only just because of the input of silver, right? Not only just because you're building out the components for GPUs, but also you need the infrastructure, the energy infrastructure in place in order to be able to expand those operations as well. There's a long-term thesis that's definitely there. So I'm right there with you. And actually, if you kind of think about those two themes in general, I don't think that there's been a time in the last 30 years where we've had those two type of secular shifts impacting metals in the way that they will impact them right now. So yeah, longer term, it's definitely. I'll make it really simple. China just needs to get off its ass, right? Like that, it's China. And when China actually, I'm kind of surprised by this, and they're doing it responsibly. That's why I'm surprised. They're doing it the right way, which is why I think the whole market is surprised right now. Back in the past, they would go out, guns blazing, right? Boom, just saturate the market with cash and capital. If they'd have to if they have to take over a particular industry or really try to crack down on some of this froth or corruption, they would do that. They go out there, spend the money, and boom, they're right back at it. They know that they have an issue when it comes to real estate, and probably the reason why we're seeing them slow roll this is it's probably a lot worse than any of us probably even suspect. I would think that that's probably the case, right? To take this type of tactical shift when it comes to stimulative policy. And if that's the case, then yeah, we might have something coming down the road. Who knows? Hopefully it doesn't come over here. But it's just been a lot slower. And their demand and their consumption rates when it comes to these metals or when it comes to these and the energy products is very large. And so once that kicks off, that'll be your long-term catalyst to the upside. And actually the Fed has to be happy right now that it has not kicked off. Because if it has kicked off, if it were in the trajectory that Jason and I have been talking about for almost a year now, I think we're getting close to that or coming up real close to that. If it was to the trajectory that the market assumed this time last year, we would be in a very bad spot in the U.S. and across the globe when it comes to commodity prices. Like that would have been a cycle, a very strong cycle. It just hasn't hit yet. And when it does, I think it'll be bullish. But for now, I look at very short term, and short term for me seems like we're giving up some pretty key levels in these in the metals when I look at copper. And if we give up 28, 27 and a half, 28 for silver, I think that also gives you that signal too that we might be in for a little bit of a rough ride here.
Yeah, I mean, this is the copper range we were talking about, and it blew right through both of those levels. So, I mean, it's just one of those things where too many people are kind of looking at it and going like, okay, this has to be this way or this has to be this way. And really, it's like commodities are trading vehicles. They have huge trends to the upside, huge trends to the downside. They're very volatile. So you just have to understand, one, the volatility, position size properly. And two is how do you hang on to some of those profits after you get these buy signals and so on. So, I mean, this is a major level that's broken through here.
Hey, Jason, are you able to scroll on top of this page?
I am not.
Oh, okay. All right. So for those that are following along, look back at Jan 2021. Okay. Does that chart pattern look eerily similar? Makes a new top, comes back, tries to make a new high, fails, goes down, consolidates, and then tries again, right? And then it starts this consolidation pattern before it starts to pop back to the upside. That's about a 7-month, 8-month period there. Notice that this is the trend that copper goes through. The charts are eerily similar through all of those peaks, especially when you're looking at the 2021 to let's say July 2022 level, where then it fully just broke down. So from a technical standpoint, are we expecting just a massive move to the downside, down to 317 without any bounces between now and then? I would say that'd be highly unlikely. You go into past performance and you say, okay, this thing's kind of maybe at its tail end. Maybe we hit that $4 level, as I kind of talked about. Maybe we bounce, consolidate, try to move higher here. But this is just the first step of this overall cycle trend that we've been kind of highlighting. And these trends for copper can last for a year and a half, 2 years. This is just the first area of it. It's just not a good look. It's not a good look right now. But just kind of be mindful of that. History rhymes, right? It may not repeat itself, but it does rhyme. And for technicals on commodities, that is something that does ring true. And you can't tell me that those 3 peaks that we see from Jan 2021 to Jan 2022 don't look eerily similar to the same type of chart pattern that we're seeing now.
No, and I mean it, but it's a couple things, right? It's what's the environment that brought on this huge rally that we saw in copper going back to 2020, and that environment isn't exactly here today. So I think that's a thing that people also have to look at is what creates these tops, what creates these bottoms, what creates these trends. It's something that I think should be talked about a lot more in trading, which is, people talk about, if you get these trades right, or if you do this. Think about when people make the most money, when everybody is making money. When you got the guy down the street who's telling you that he bought GameStop and he made this much money and all this. It's a liquidity-driven market. And when you see liquidity everywhere, the guys that don't know exactly where to buy or exactly where to sell or any of those things, everybody can make money. So you basically got that type of environment 2020 into even 2021 a little bit. So however, we gotta be very open to there is not a ton of liquidity right now. Yes, rates might be coming down. Yes, liquidity could be popping back up a little bit, but the environment that creates these major commodity trends, I'm not seeing it just yet. So we have to kind of be patient here. I think I agree with Kevin in the sense that commodities have a lot of consolidation ahead. But to me, I want to see oil start to move. When I see oil start to move, I'd say, hey, maybe copper can start to move again. Because really, copper just kind of got ahead of itself. It had a huge move to the upside, got ahead of itself, pulled back, broke down. So copper just kind of got ahead of itself. So we'll see where that one ends up. But Kevin, I also had another one for you that I wanted to bring up. So this came up on the other show the other day. And I thought this is just the first one I could find on Google. If anybody hates the Register, I've never even heard of the Register. It was just on the top of the list for news. But it's on everything. You can go to New York Times, whatever. This Bill Gates story is on everything. And it says Bill Gates says not to worry about AI gobbling up energy. Tech will adapt. I think that is a absolute crazy statement. But maybe you have a better. George and I talked about it the other week and went, we need to bring on somebody who would know a little bit more about it. And I mentioned, well, maybe Kevin. I'd ask Kevin about it. So, Kevin, do you have any thoughts on what Bill Gates said here?
Yeah, so he is right, and I know it sounds asinine right now, but he is right in a sense. Okay, so 2 things. I sent you an article that I wrote. I just sent it to you in your DMs because I'm having some issues here, but. So he is correct. What will happen in the tech cycle, especially when you're talking about software, is we have the initial foundation. What we are doing right now when it comes to AI is kind of, I'll use the rough analogy of brute force artificial intelligence learning, right? You take as much data as you possibly can and you're just shoving it down and you're just saying, hey, find the patterns, find the correlations, learn all of this. They just continue to throw it into these models, right? And that's been effective for right now, especially when you're looking at large language models. That's been effective. Meta's already kind of working on this process in the background, and they've been doing this for the last couple of years. So this is Meta. You can talk about Mark Zuckerberg to your heart content about how people don't like him and all that stuff, but the guy has been the most supportive, in my opinion, for computer programming and artificial intelligence and just data analytics and modeling than anybody else that's been in this industry. And Meta has a lot of great free open source software that's out there to be able to help people build out their large language. Like a lot lot of the large language models that people are putting on their own sites is being built off Llama, and Llama's free. That's from Meta. But Meta has a paper, and I don't have it offhand, but they wrote a paper about a year ago, let's say like 8 months ago, and they talked about, yeah, everything is great when you're looking at these large language models. But the next wave of this whole space is how you can generate or create a learning system that takes less data but gives you the same result, right? And that's all models are. You can have very complex models that have all of these different inputs, and you can create a really decent model, but at the end of the day, is it scalable? And then you could use maybe a little bit less when it comes to the amount of data, but if you have the right matrix in place, you can actually come up with a really solid model. So they're building out these matrix learning algorithms and stuff like that. All right, that's enough than the nerding out for that side. So that in general itself, when you're talking about the different ways on trying to build out models, large language models and all these other things for AI will fundamentally change, because the software engineers, when you're in this type of tech space, there's two things that happen, right? You get the software, you get the hardware spend. That's what we're seeing right now. You get the hardware, and then those managers and those software developers, those managing directors, the VPs are going to say, okay, you have the tools, let's make it happen. And the software developers are going to do as much as they possibly can, and to a point that they're going to say, okay, we need more hardware. And at the top, they're going to say, you got to make do with what you have. We have all been in companies like that, right? And those software developers are going to then say, okay, well, what other ways can we accomplish this? And that's how technology is put through. So what I would assume is in the next 5 years, will see different learning capabilities or different modeling capabilities in order to try to achieve the same outcomes with utilizing less data. With utilizing less data, you'll utilize less energy. That's the thought. That's one thing. Two, it's all about location when you're looking at AI data centers, okay? So the biggest fear right now is like you're gonna have this massive draw on the grid. Yeah, you're gonna have a massive draw on the grid if you're building out all of your data centers in Texas, right? Texas is not on a national grid at all. It only has like one opportunity or one outlet in order for it to get spare capacity into its own system. But it's for the most part a closed system. And so if everybody says, yeah, we're gonna go to Austin and like build all these data centers in Austin, that's the wrong move. That's where you draw on the grid. If you say, okay, we're going to build out a whole bunch of data centers in LA, that's the wrong strategic move. But if you say, hey, we're going to build out a grid in Hodunk, Iowa, somewhere that has ample
or
amount of
Ohio,
or Ohio,
where they are. Yeah.
Washington State's another one that's growing really big when you're looking at the AI front. Outside of Nevada, outside of Las Vegas, but actually just like in the middle of nowhere in Nevada, these places that just don't have that much demand already is where these data centers are going to come. And if they are able to do that, then you don't have as much stress when it comes to the grid overall. In that article, I kind of wrote the expansion that's being expected when it comes to data consumption or when it comes to electricity consumption by 2030 compared to what we are bringing online every year in spare capacity is literally only like 0.2%, 0.3% of everything that we're bringing online. So the electricity narrative will be there, right? But it's not like it's going to take half of the capacity that we're bringing online already, right? Which would be completely unexpected. That's where it's a very small portion. So check out that article. It's a very short, brief one, but it's kind of like signaling. It's really meant for utility companies. That's what I was kind of talking about it, because it's like people are just throwing money at utility companies, and it's like, well, some of them are going to win, some of them won't. Well, some of them won't even have any impact, right? And so you kind of have to look at like what it's going to be. But once again, what Bill Gates is saying is something that rings true in the technology cycle since the internet boom, right? And so he's right. Eventually, it's not going to gobble up. Right now, it is, because we're just doing this brute force. Like, people are just saying, give me everything that you got, and we're just going to squeeze it into these GPUs and then just build out the best models. But that's not always the best way to go. Real quick, if you look at certain like pricing models for stores, right? There's a seasonality impact that you have. Let me not even go there. Airlines, right? Airline traffic and profitability. I think we all understand that there is a direct correlation with the higher traffic that you have, the more profitability that you have in a sense, right? Barring any capacity changes and things of that nature. You can build out all of these models on a bunch of different data sets to try to pinpoint profitability for these companies, but a lot of them still run linear models that only have a few inputs to say, okay, here's what we can actually project for the future. Because even though you have all these other external inputs, it really doesn't mean much unless you get people walking into the doors and you have capacity of planes on the runways or at the gates. Regardless of you can take all of these. So I'm just basically saying that like sometimes models and sometimes the application for certain things does not have to be complex. And corporations will realize that. Right now they're just on a spending spree, but at some point they're going to say, okay, maybe this is not. Do I need AI to be able to project my sales cycles? Probably not. That's basically the end all be all there.
No, that's well said, and that's kind of why I wanted to bounce it off you, because obviously today I see that's like you said, they're pushing it through, numbers are moving, but over time, what is the exact impact? So that's why I wanted to push it to you, because in the short term, it's easy to see up, but like you said, if we were to take what people thought of technology and energy consumption going back to the 70s. Most people would have said, okay, technology is going to come in, it's going to create the most insane energy prices ever, and oil's never going to come down again. And really, that there was the peak oil theory and all that, and oil was just going to continue up higher and higher and higher, which the price wasn't exactly true. It doesn't mean that the peak oil theory is completely wrong, but price-wise, it wasn't right. So I think you make a lot of sense with that. So I'm glad you explained that to us.
And if you look at the bottom of that article, research by Goldman Sachs and the Electric Power Research Institute forecast that present trends, data centers in the U.S. could account for up to 9% of all electricity used by 2030. And that could be right. Mm-hmm. You're also offsetting the efficiency gains and the lack of labor that you're going to need for those systems as well, which labor does also take electricity consumption in order. So there will be a little bit of a balancing out, but even to see that type of growth compared to, we're basically bringing online every year an additional, let's say 2.5 to 3% of capacity, additional capacity when you're looking at gigawatt hours to the grid every year on average, right? Regardless if we had AI or not. So I think the capacity is going to be fine. It's just where they put it. The location is key. The location's key. And I don't see a lot of companies. I mean, you're going to get a couple of them that go to the hot spots, right? Because they have the labor market there. But a lot of them are going to go, you're going to be like, your data centers are where? This place that no one's heard of in Washington. Google just announced that they're going to be doing a data center with somebody, I forgot. It's somebody big. But they're doing it in like Aurora, Illinois, which is kind of like where I'm from. And what I find funny about that is like initially when you hear that, you would say, oh man, it's a major population center. It's like a huge big deal and that's going to draw in electricity. But if you kind of think about it, we have a lot of spare capacity here in the United States, here in Illinois, because west of Aurora is nothing but cornfields. So it's just, how it is.
No,
I think this company,
we got the same
Kevin,
thing here. Go ahead, Sam.
Do you know NewScale Power? I've seen this several times, like it's like the #1 trending ticker on StockTwits. But people are talking about this, like it's they're making these small nuclear reactors that AI data centers will just build on their own, so they don't need to worry about the grid so much. I think this is kind of an interesting company. Like they've rallied 800% off their last November's low. Like,
there will be
something here. I don't know.
Yeah, that is the thing. Especially, I believe the EPA kind of like, I'm not going to say they gave them the green light, but the government, no matter what side, is definitely open to nuclear technology a little bit more, which is why we saw that run up when it came to uranium. And the smaller and mid-sized nuclear reactor companies that are going to be able to try to ramp those up have been in a very strong demand. I mean, it's a route to do so. There's another one called Faro Energy. I brought it up like a couple months ago, where they're utilizing fracking technology that energy companies use, and they're basically getting into hot rock, and then they're basically piping in pressurized water through these pipes, and then it comes up the pipe, turns a turbine, and they're self-sustaining 2 data centers in Nevada for Google. Right, so a lot of these technologies will hit the market here, and I think there's a lot of optimism there. So, and in that article, it was kind of funny that they said the ARM CEO said it was going to be 20 to 25% of the grid was going to be utilized just for AI, and then right under it is like, yeah, granted, he's also trying to sell systems too. So 20 to 25% of the grid being utilized just for AI and data centers for AI, I feel like is very far-fetched number there.
No, that's why I want to pass it to you, because I was like, I'm not. I keep saying that's not something that I study, something I'm not jumping deeply in, but Kevin does, so I would absolutely try to pass that on to Kevin. So glad you have a great answer on that. Bunch of great research, good back and forth from both you guys. And so, Sam, here's another chart of yours. And I also like this is funny, because I was thinking about this the other day. I was like, man, it'd be funny to just create a thing that just or like a channel that's just called like not a top, like just something that's just not a top, because there's so many people who are like, every flag pattern is a top, every time anything consolidates it's a top, everybody draws head and shoulders on things. And especially with stocks, stocks really kind of tend to run. So what are you seeing here, Sam?
Yeah, we could make a sell the puts naked channel. I think that's more. That's a better name. So SCCO is one of my favorite copper stocks. It's a big boy, 82 billion, rallied 250% off the COVID lows into a multi-year basing pattern. We've hit the first Fibonacci extension, and we've just been consolidating around here. I'm thinking about selling some puts against like the 107, 105 range. As long as it's above 100, really, I think this could turn into just more of a consolidation pattern and not resolve lower and retest the 82.5 range. This one has my attention, though, just to go back to the metals conversation we were having earlier.
So when you're looking
at how
at
I want to profit from it.
So when you're looking at this type of chart, do you look at the copper chart and say, okay, if copper is doing this, I would be more interested in doing this, or are you just looking at this chart alone?
Well, it's more that like copper is almost oversold, and on the 14-day RSI, which has been a fantastic place to kind of buy the dip and get a little mean inversion rally. And like SECO has shown a ton of relative strength, hasn't been able to get oversold in over 2 years now. It's still above the 2022 peak. There's a lot of things to like here. It's not just copper. Relative strength also stands out to me. And I think there's more going on here than copper as well. It's more a play on industrial and base metals. I think they have a larger portfolio.
Yeah, and they're in a lot of the larger ETFs as well. So
for sure.
Kevin, do you have any thoughts on SCCO? Yeah, mute.
Yeah, so this is definitely, I think, one of the bigger copper plays that are out there. Once I would say maybe if you're looking at a pullback to around 82, I mean, you have it up there, 82, let's say 82 and a half, $82.40, I think would be kind of reasonable. This stock has lost its luster when you're looking at the dividend yield, though. It's like that, like the buyers, let me just say it like this. The buyers that have been in this name since $70 to $80 and they're seeing the price right now, I mean, they're locked in. I mean, they're hitting almost 4% dividend yield, maybe 4.25 div on this stock, and they saw this type of stock appreciation. So you got sticky flows there just for the long-term investor for now. I think it trades the way that copper goes for the direction. Now they might have a little bit more wiggle room when it comes to their conference call and talk about the physical demand that is out there, where they might say, hey, yeah, we locked in some long-term contracts. We see demand going up, blah, 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 right? Like that could be a tailwind for them. But, nice breakout. I think it's just time for maybe a little bit of a consolidation. Maybe you see a pullback and retest, but just based on the yield. I mean, the yield is still at what, 3.25%, 3%. I mean, it's still a decent and healthy yield for a metals company, a mining company. But I don't know. I'm not saying I'm like bearish on copper. It's just that once we broke that range, for me, it's kind of like, all right, where do we go from here? Because that was where you needed bulls to really step in and hold their ground. And maybe they do come in and try to step in, but that type of chart pattern, and copper trades really good on the technical. It used to trade really good on the technicals. So if you're saying, okay, there's a major technical breakdown, you just stay cautious until it can actually regroup. But decent dividend pair, but once again, maybe come back, test, bounce, push back higher. I think that would still be healthy for this stock.
Yeah, I think it's also important to go, okay, if we do have this type of a pattern here and we go, okay, well, let's see if we can get back over that 107. Can we get back over 110? Possibly looking to really get a major position when we get back above these areas, or if we get a major pullback. That's the thing. When we do break down, we see these types of breakdowns, those levels of 82 start to be possible. So if we see 82 to 85, I think that's a good accumulation zone for the long-term type investor. Also, I'm not an accumulation trader as things are dropping. I'd rather buy things as they're breaking out or making new highs or something. Not saying all-time highs, but 50-day highs, 100-day highs, something. Right now, it does look like it's rounding out, but that doesn't mean that it can't come up here. So I think this is a great chart to keep on everybody's watch list. Copper does start to turn up, regain those ranges that we talked about earlier. If this starts to get above those major levels and close above 108 again, might be something people want to look at here. So I think it's a good chart to have on everybody's radar.
And to say this too, actually, can we go back to that real quick?
Mhm.
Because like Sam, you were kind of talking about like, hey, like, and I wouldn't be negative on this. I think the strategy of selling puts or maybe selling put spreads, right, is something that you can look at. Selling a put outright, just for those that know, and this is just an example, not an advice or anything. Selling a put outright at, let's say, that $80 level, and if you're trying to scalp premiums there, or I mean, $80 seems like that's the technical, a decent technical level, right? Maybe these levels right now you want to go and try it if you have a decent amount of IV, a decent amount of premium. But at the $80 level, you're looking at $8,000 per contract for the margin requirements on selling puts, unless you have like a level, the most experienced level on your account, and you can sell naked regardless, and they put a smaller margin requirement on it. But for the most part, all of us are going to be sitting at $8,000 for that margin minus the premium that you receive. If you're able to do that and you feel comfortable with that, then that's cool. You're locking that up. But you can also look at selling that $80 put. You could also look at then buying a really out of the money put, right, to be able to reduce the margin requirement itself. So maybe you buy something that's at 5 cents or something like that, but you can actually reduce your margin requirement, say by $4,000, $5,000. That becomes a little bit more tactical. And then, hey, if it comes down and hits that level, or it goes below that level, then you have your entry point. You have like this wheel strategy, right, where you're selling puts to get into a trade to establish it. If it goes at the money or in the money, boom, you get assigned the stock, right? You get assigned the stock. You sell you get a dividend for it. That's your income stream, and then you sell upside calls against it. That's your wheel strategy, right? You sell those upside calls until you get called away, or you continue to roll up, and then you start it over again. Sell puts, buy the stock, sell calls against it, get the dividend, and just continue to do that wheel slide. So that would be kind of the longer term strategy in my head. That would make a lot of sense for a name that's popped like this, that probably still has a relative high IV on, if you're looking at a 4-year, 5-year chart, I bet it's still elevated to be able to make those premiums potentially worth it for those that are looking at it.
No, I like.
Is that
I
what you're
like.
thinking, Sam? I'm sorry.
Absolutely, yeah.
Okay.
You're spot on, Kevin. There's a lot of ways you can play it.
Yeah.
So we only have a little bit more time left. So do you want to end on this one, Sam, or do you have another chart you wanted us to go to?
We wanted to finish with silver. Let's finish
Silver.
with silver.
Okay.
Yeah.
Do you have silver on here? I'm assuming you do.
It's-
I'm on full screen, so I can't see.
It's the next chart.
Next chart. Okay.
Yeah.
All right. So silver's here.
Yeah.
Great chart here from Sam. I'll let you explain it, Sam. Go ahead.
Yeah, we've been talking about this level in silver. We've been here for several weeks now. Can't get it done. Can't break out higher. Kevin loves his weekly MACD. We have finally gotten the weekly MACD sell signal. Are we shorting silver here or what, Kevin?
I can't say short or go long. What I will say is from a technical standpoint, I gotta protect myself here, Sam. I already got in trouble once. Let me protect myself. If you were a technical trader here and you saw that MACD cross and you look in the past and what has happened in the past with that MACD cross, especially at that elevated level, you could make the assumption that we might be at a topping formation and we do see a pullback down. There are structural and fundamental areas in this market, though, that we have to just kind of keep in mind when it comes to physical supply. So physical supply is still in a deficit overall, net in physical markets, okay? You add the ETF side of it, you add the SLVs, you add some of the other ETFs, and you look at what they have to cover for contracts, that makes that deficit for physical even a lot worse. But even if you have a deficit, does not mean that you have to have positive price advancement, right? So what I would say is technically, yeah, I you know me and MACDs, man. Like once that bad boy crosses, I would say that's a little bit more concerning for me. It has been able to consolidate here, but the consolidation pattern has been more lower highs, right? And then sustainable lows as far as price support. Right. So that's something you don't want to see. You would like to see like maybe lower highs, but making higher lows as well, coming to an apex and then breaking either to the upside or downside. We have more of a like, I wouldn't even call it. What is it? It's not like a descending a triangle because you're not already in a descending market, but it's kind of like that type of trend where you have a solid support line and then you have declining highs coming to an apex. It just seems like we're failing it. With that MACD there, I would say everybody and their mother's probably looking at that MACD and saying, okay, maybe we come back and pull back here. MACD, though, does not tell you the aggressiveness of a move to the downside, though. We have to kind of stress that. We have that one that's in, 2021, right? That very high move to the upside. We have that cross. What is that? COVID? Probably, most likely COVID. And then we had that sharp decline to the downside. Okay. But if you kind of look at it, there's another one that's in right past 2022 where we weren't aggressively above that zero line. In fact, we were still kind of in bearish territory. And you would think across there would not be an aggressive sell-off, but it was. It was actually more deeper than what you saw in 2020. So you can't use the MACDs and say, man, look how high it is, and it just crossed. Look how much it can go down. You look at it and say, it just indicates that selling can occur. It doesn't give you a price example. You go back on those lines on the chart and say, what could be reasonable? Can $25 be reasonable? Sure. It was recent highs that we tested and failed, and then it broke out. Old resistance becomes new support. 25 would be your first level. Second one is going to be about 21 and a half. And then you kind of go down the scale from there. But this looks more bearish than bullish. We've already talked about the macro factors that are in place here. You know, I don't know. Technically, it does look like this is going to be a sell. What do you think, Sam?
For sure, I agree. MACD's it's very useful for timing. Doesn't tell you the magnitude of the move.
Yeah.
I don't think we're going to sell off and go back to 15 or anything. We're just going to be back in the box. 25 is a fair target, like you mentioned. I don't think we go much below that.
Yeah. What do you think, Jason?
I think honestly we hold on to trend here. If I was looking on at and here's the thing about it with MACDs, which is always interesting. The first person I ever learned how to trade from, which was when we're talking about things like MACDs, when we're talking about these pinches on MACDs, sometimes you see when we're above like major moving averages, we're holding trend, and you see these MACD pinches. Most of the time, those can be bounce areas at times. So we see bounces around those zones from time to time. The thing that I would continue to look for, though, is one, it's an incredibly important signal. It doesn't mean what I'm saying doesn't mean I'm not going to take it and say, hey, that's not important. But I think as long as we're holding these levels, I wouldn't be too bearish on it. I wouldn't look into it too much just yet until we start to really break down, start to make lower lows, lower highs. So, with Sam, I have the same idea. I don't know about the pullback. And also something that's really important, like Kevin mentioned, and this is incredibly important, and I hope people picked up on this, which is you've got this trend up in the end of 21 into 22. And then it has this major sell-off. But what's the difference in the MACD cross up here and back there? Well, that's because the MACD is also showing that there's not much momentum. We're below the zero line at that point. So momentum is also incredibly important. Right now, we're in a very high momentum environment for silver. I would say that would mean that the pullback will probably be shallow, if at all. And you should probably not be looking for this to come back to $20 or something like that, or 15. I think at most 25, like Sam. I'd agree with Sam on that one.
And then what's different with this, just to once again reiterate, the fundamentals for the most part are there. It's right. I mean, when you're looking at the actual stockpiles themselves, right? You're looking at the actual deficit that's out there, the physical market. There's a fundamental case there, right? But why did silver move up the way that it did? I'm going to say X gold, because gold can kind of do its own thing. Why did silver move the way it did? Why did copper move the way it did at the first half of this year? What did we also have at the first half of this year? Inflation, right? We had 3 prints of hot inflation that was going on. That was that reflation, situation, right? So silver got that precious metal behavior. The dollar slid last week, right? If I'm not mistaken, I think on Friday it kind of caught a bounce. If I'm not mistaken, I'm sorry, y'all. I'm still kind of getting in the swing of things here, but it doesn't seem like the commodities, especially if you're looking at silver and gasoline and crude, they're not really respecting these dollar moves. And when it didn't respect the dollar moves to the upside, then why do we expect it to actually respect the dollar moves to the downside? Remember that we talked about that about a month and a half ago. And it's a key thing. It'll fake you out if you're tying yourself to the dollar moves and what could happen to commodities. Can it spark export demand? Yes. Okay. But that doesn't mean that it's going to immediately be reflected in price until we see the export demand going up for a lot of these things. So I don't know, man. I don't think it's silver's out of its trading range anyway. I mean, it broke all of its technical things that I would say, like for sure, this is where I have conviction in. That spike to the upside and the break of those trends after 3 years of kind of being in really good technical territory from highs, lows, and being able to scalp that trade basically the whole time is in a little bit of a different range. I think you come back down to 25, you kind of test that, see what the appetite's like, and then you push higher from there. And if not, and we have a breakdown, it is not outside of the realm of possibility that we start ranging out between 20 and 25 again. I mean, that is familiar territory for the contract. That I wouldn't go against that, but there's there's already maybe the fundamentals are already priced into silver. That's kind of what I'm saying. Maybe all that stuff that I talked about, EVs maybe priced in. AI might already be priced in. The reflation trade in China might be priced. We don't know. That's the great thing about price. You really don't know until it's too late, really. So, but it looks horrible. It looks like horrible.
Well, I mean, I think that is in general, when you look at the market, you have to really kind of think of things like you just said, like you got to look at the bullish and bearish thesis, but also you have to follow the price. And like the trends are still holding. I wouldn't be too bearish on it as long as the trends are still holding. But, we start to break below these major levels. 27 is one of our major levels. 25 is the ultimate level. everything needs to be out at that point. You know, we start to break these levels. I wouldn't be surprised if we get back to that $20 to $25 range. But for now, I wouldn't be too bearish on silver. I wouldn't be too bearish on gold. I would think that the fundamental case should hold up, as well as the technical case. But really pay attention to the price action, because everybody can always be wrong, and the price is the truth. Like you see what's the truth. You only get paid through this. If this breaks these major levels, like, I'm not going to just continue to hold it because I think that the fundamental case makes more sense. I'm going to go, I need to get out of it because I don't know anything. I just know what the price is telling me. The price is telling me to get out. So cool, guys. Thanks for coming on, everybody. Thanks for joining us today. Glad Kevin's back. Sam, thanks for joining us. The charts, please follow these guys. You know, we put a lot of work into these every single week. So follow Sam, follow Kevin. Also, I posted any of the links for Kevin, what he was talking about, on Twitter. So please check out Twitter. Also on YouTube, it's in the comments. So, all right, guys. Thank you guys so much for joining us. And we'll see you next week at 11 a.m. on Mondays.